Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
On this episode, we have Peter Neill, co-founder of GSP Real Estate. Peter plays an active role in the management of the company and their fund offerings. He works closely with the managing partner on all aspects of the business, especially handling the fundraising side of things. Peter has a background where he was originally a note investor at one point in time, working for a note fund until leaving to start this company. He is in Pennsylvania, avid dog lover with his Beagle, graduate Temple University, investor in workplace housing in Philadelphia area and in Baltimore. And in this episode, before I bring Peter on, I just want to mention that what I love about this episode is, understanding what Peter does from his business standpoint to what we do, and it's actually very similar, just at different phases. Where, as people know, we like to buy and fix and flip mortgage notes, where we try and rehabilitate the borrower. Peter does it on the real estate side, where he wants to buy the real estate, rehab it, get it rented, refinance it, so then he can take that money and recirculate it back out, also known as the BURR strategy. So hope you enjoy this episode of Creating Wealth Simplified with Peter. And let me welcome Peter and bring him in right now. Hey, Peter, how are you today?
Chris, I'm feeling very good. How about yourself?
Good. It's we're recording this in the middle of the week, so we're almost through before we hit the Thanksgiving break, which this will get republished after Thanksgiving, but recording it right around that time for people sometimes ask what that information was based on, but. So, Peter, as I always like to start, why don't you tell people what you have going on right now and then rewind it to tell us how you got here?
Sure. Wow, that's a good way to get started and kick this off. So, I've co-founded a company called GSP REI a little bit over 5 years ago, and we've pretty much been doing the same thing since inception. We're built to invest in primarily single family workforce and affordable housing. So what I mean by that is, typically it's single family homes valued under $250,000. We're operators, so we do everything in-house, from the construction to the property management. So our specialty is really buying blighted properties, so fully distressed property, something we can pick up at a very significant discount to market, go in and pretty much rebuild the home within the four walls. At that point, we have the option to sell it on the market, so at a markup from obviously what we paid for it, for a short-term profit, or we can hold it as a long-term income-producing rental, which tends to be our strategy. One thing that brought myself and my partners together was the long-term buy and hold strategy, and our like for that approach. So that's essentially what we do. We manage funds, we raise capital from accredited investors, and then we use that capital to acquire and then do the construction. We'll put a tenant in place, and then we'll put long-term financing in. So it's essentially a BURR strategy at the end of the day.
Okay.
And we love single family. We see a lot of demand in that space, and just a lot of supply constraints, especially in the markets that we're in. I live in the suburbs of Philadelphia. We operate in the city of Philadelphia, surrounding suburbs. We operate in the city of Baltimore and the surrounding suburbs, and then some parts of South Jersey. So areas where there's a need for workforce and affordable housing and just massive supply constraints. And then to speak to your other question, I started November actually is my 10-year anniversary in real estate. I can't believe it. It's
Okay.
flew by. And I got my start in working at a distressed mortgage investment company. And that was all, single family backed assets at the end of the day. So that was kind of also my introduction to single family. While I was there, I was kind of the right-hand man to the CEO, who was an investor well beyond, just second mortgages and first mortgages and that kind of thing. So he really introduced me to real estate investing as a whole. He had a nice portfolio of single-family homes, small multifamily, kind of similar to some of the stuff that we have now. So that was really my introduction to the investing side of it. Going back even further, growing up, my father was a property manager, facilities manager, primarily on the commercial side, doing banks and industrial and office buildings, retail, shopping centers, you name it. But he did some single family stuff, especially early on. So I grew up in like the management side of the business and always thought, I don't know if real estate's necessarily for me. And then, when I got that first job out of school working at the distressed mortgage investment company and seeing the investment side of the business, it was like, all right, I like this a lot. And I never really looked back. It's been 10 years and I've enjoyed pretty much every day of it.
Nice. Yes, you work for a competitor of ours, which I joke they're really not a competitor because, it's like, comparing, Michael Jordan to, a D1 college athlete from that standpoint. And it was interesting as an engineer and numbers guy, I actually realized, I was thinking the other day how long I've been in real estate. So I'm like, oh, let me calculate like how many days I've actually been in real estate, as a
Mm.
full-time job and stuff. And, on a 365-day calendar, I actually just passed 10,000 days in real estate. And I'm like,
Yeah.
man, that's, again, cool number. But
Sure.
so interestingly, you mentioned, okay, so you're doing the BURR strategy for people who are listening that don't understand the BURR. It's you
Mhm.
buy a property, you rehab it, you refinance it, and then I forget what the other R is,
You
basically.
buy it, you rehab it, you
That,
rent it,
that
and
oh,
then you
rent and you
refinance it,
refinance it.
and
Yes.
then you recycle, repeat,
Yeah.
that kind of thing.
Exactly, which it's interesting because there's a lot of individual investors who do this strategy, but to do it at a fund level
Yeah.
is really interesting. And what is unique about your fund that I think is also similar to unique about ours is, we're both really doing the same thing in essence, but just at different life cycles. Whereas we buy a defaulted loan where we want to rehab the borrower to get them repaying to either refinance the property or we sell that loan. Or if we take it back, the exit the property, the first person we would call is somebody like you, Peter, as an investor who's looking for these properties, because I think one of the nuances in note investing that people don't realize is, most people think that a property is, you're going to go take it back, is going to be beautiful and nice and clean on
Mm.
the inside. And I was actually shocked that we had two loans recently, both were in bankruptcy. The
Mm.
borrowers had gone 2 years without paying in bankruptcy, or
Mm.
then they structured a payment that started like at $100 a month. It was insane. And we're
Okay.
talking, $500,000 properties.
Mm.
And they finally got dismissed from bankruptcy, meaning that they didn't have protection anymore. And they put the houses on the market to sell. And I'm sitting here thinking, oh, I can only imagine. But both properties were immaculate, like some of them
Sure.
newly renovated. And I'm
Yeah.
like, well, at least I know where they were taking the money, not paying their mortgage, where they were putting it at least. But
Yeah. Yeah.
so
We
now,
see it. I mean, we
yeah,
have a mortgage side of our business. My partner Wade runs that,
yeah,
and there's certainly synergies. We're like note investors that don't mind touching the property. A lot of
yeah,
times, especially coming from seconds, and knowing a
oh
lot
yeah,
of second mortgage investors, the last thing they want is the property. They want a workout agreement, they want a payment plan. But with first mortgages, depending on what you buy, and we primarily buy HECM loans where the borrower is
Oh,
deceased, like
there
a
you go.
vacant. I mean, so there's no one there to, get a workout agreement with,
Yeah.
that kind of thing. So we end up taking the property back, and then we'll touch about 90% of what we own in some way, shape, or form to add value, and then put it on the market, which is kind of a big differentiator because a lot of note investors, last thing they want to do is touch the property. But essentially, like you said, it's a similar strategy in the sense that you're buying a property, you're buying a paper at a discount, you're adding value through this workout agreement, and then you can sell it now as a reperforming loan at a
Yep.
markup from what you bought it at, or you can keep it as kind of like a rental, as a payment on a payment plan, that kind of thing.
Yep. In this last HECM pool, did you get any of the loans in the last one?
We did. Yeah. Yeah. I was
Okay.
actually just talking to Wade about that. I think we won 20 million maybe. And
Oh,
I don't know how
nice.
many loans it came out to, but yeah, we bid the whole thing. I mean, it was 150, 190 or something like that million. And
Yep.
we won 20. So, which is about right. I mean, you're not
Yep.
going to win them all, that kind of thing. But, yeah. And you probably don't want to win them all. That means you probably paid too
Yep.
much. So it's one of those things, right? Where it's like, if you're
Yeah.
winning too many, then you're probably overpaid. But yeah, we did. And it's something where it's a part of the business. It's not a part of our funds like that we raise capital for. They're all real properties.
Yep.
But there is some synergy there, depending on how we buy and what we're buying, where you could be getting properties at an even better discount, buying them in the paper position. Pre-REO is a word that I like to use.
Yep.
You hear thrown around, because, like I said, it's a vacant property. There's no possibility for a workout agreement. So you're going to take the
Yep.
property back. And if it's in our target market, which is, like I said, Philadelphia, Baltimore, South Jersey, it could be something that fits for the rental portfolio, that kind of thing. So it's a different way of looking at the paper space
Yeah.
than most people do.
Yeah, we put in, so this is my first go around with these, and we put some numbers in. Unfortunately, we didn't get any, but no, it's good. I'd rather not get any than get everything I bid. Because as
Exactly.
you
Yeah.
said,
Yeah.
then if you win everything,
Oh
we're
yeah.
looking at the new pool right now that bids in, 3 weeks or whatever. And
Hmm.
it's interesting though that, I'm curious,
They're occupied, I believe, aren't they? They
yeah,
they
these are
are.
occupied.
Yeah, they're
Well,
occupied. Yeah,
they
we're
say they're
watching that. We're not
occupied,
bidding it
but
though.
some of the ones that we've looked at, I don't think they're occupied. I mean, they may
I can
think they're
believe it.
occupied. Yep.
Yeah,
But
yeah. Then they might not,
yeah,
but yeah, I think it could be squatters, it could be
yep,
tenants, or it could be like an heir or something like that.
yep. So, but I'm curious because, for people, HECMs are reverse mortgages where people essentially get, it's a reverse mortgage is you don't have to make payments, and you basically get money over time or get money from you have to be, I think, over 55 or 60 years old to get them. You have to go through all this program, but it's a program for, people who are elder in life that, can't afford taxes, insurance, and a lot of these in mortgages anymore. So and they have a lot of equity, which they built
Yeah,
over time. So it helps them come through.
yeah,
And, they've just released, I mean, the two combined totals are, I don't know what, 6, 7, 800 million dollars in
it's a lot.
these loans that are now non-performing because when the borrower deceased, passes away, a lot of them are actually underwater for some odd reason. I don't know why, but whatever case may be. Government inefficiencies of valuing property, I guess.
Yeah, though they're sitting on a lot of loans and that kind of
Yeah,
thing. And but to your point though from before, it's sometimes they could be putting the money into the property, and
yep,
they're tapping the equity, they're making improvements to the property. So yeah, we've certainly over the years been surprised by the
yep,
condition of the actual property. But not always the case. I mean, there's horror stories too where the
yep,
property it'd be, but and when you do it long enough, you kind of know from looking at it, and BPO, like pictures and stuff like that. I mean, it's the
yep.
typical, however the inside looks is probably going to give you an idea of, or however the outside looks is
Yes,
probably
that
going to give
looks,
you an
yep,
idea of the inside, that kind of thing. So it spans the spectrum. But yeah, to your point, and I remember too, back in the day, it's just like a lot of these people were, I don't know if a lot, but there was always a percentage of doctors, attorneys, like people who made good money, and they were just kind of gaming the system. They just, it was a second home or something like that, and they just stopped paying, and nobody ever went after them, so they just kind
yep,
of kept not paying.
yep,
So it's just like you see a lot doing that business long enough, you hear and see a lot of different stories. It's crazy.
yep. No, you do. Now, Shifting gears a little bit, as we wrap up the end of the year, coming up on 2025 in regards to, real estate. And I believe real estate today is more of a, driven by specific markets. You can't really
Yeah.
look at it on national level, but, Philly is going to be very different than Austin, as an
Sure.
example. And, based on where you're located in your target markets, where are you seeing 2025 start to pan out? Is, you seeing more inventory come in? You seeing
Yeah.
prices settle down a little bit? Rental
Mm.
rates overall, kind of, what are you seeing coming forward
Yeah.
for next year in your
Well,
markets?
it's a great question, and I think of it the same way. I hear a lot of people will say they look at macro trends and things like that, and it's like that's nice to a certain degree, but you really have to know your market and what's happening in your market. That's why I tend to not like pay too much mind to like the national news and things like real estate news that you hear on television or in like, national articles, because they're taking information from all over the country, and like those micro trends can be so different. So for us, from a macro perspective, I love workforce and affordable housing,
Yep.
single family and multifamily too. You know what I mean? Like it just, the deal needs to be right, but there's such a supply constraint for that type of product. We're not creating new units on either side of the spectrum, really, especially on single family. I think it was less than 3% of new homes built were valued under 250,000. So it's like they're a scarce
Wow. Yeah.
commodity,
Mhm.
So I like that part of the business. I think that it's only getting worse. You know what I mean? There's nothing happening on a state or federal, local level that we're seeing in our markets or really in any market that's creating this huge influx of affordable units, and there's really a lot of that. It's become part of the national conversation more and more. And Harris had talked about it, with creating more units and things like that. And it sounds good, but a lot of it's local issue. You know what I mean? Like with
Yeah.
zoning and you probably don't want the federal government coming in and telling, local zoning what they can and can't do and stuff like that. I mean, you're gonna get pushed back there big time. So it creates an opportunity though. You know what I mean? So that's why I like what we're doing with workforce affordable housing, especially on the single family side, because when money is created through grants or through the federal government and stuff like that, it tends to go to large institutions that therefore develop large apartments and communities and
Yeah.
things like that. And a lot of times that tends to be studios, 1 bedrooms, 2 bedrooms, and a very small percentage is 3 or 4 bedrooms, almost like unheard of. Yeah, it's the smallest percentage. So massive demand for those 3 4 bedroom type homes, where because you have families that need this type of
Yeah.
product as well. And also and then the other thing is I love the markets that we're in, because unfortunately we didn't experience the massive appreciation that some of the South and the Midwest and say Rust Belt and those areas have over the last few years. And they're starting to claw back too,
Pull back.
and
Yeah.
yeah, rents are leveling off, value appreciation's leveling off, and a lot of that has to do with, because when they get that kind of migration, it not only supercharges the investors in those markets, but then it gets national attention, and investors are coming from all over. I know people in the Philadelphia area that are going down to Austin, or they're going to Atlanta, or they're going to these different, Arizona, all these different markets. So then that creates a lot more supply, so a lot of new
Yeah.
development has come online and coming online. So I think that there's still a massive need for affordable workforce housing. There's still a massive need for the single family. When you look at the gap between new housing starts versus new housing formation. But to your point, there in some markets in the South and in different parts, there's been a lot more development. There's been a lot more
Yeah.
supply, so it has started to level off. We've seen some tick up in supply in our markets, but we're still seeing appreciation of rents and home values. And I think we're going to continue to, because we just don't have, it's the built environment environment. We're investing in urban metropolitan areas, even in the surrounding suburbs of them. So there's not opportunity for, these huge, large tracts of lands being developed, like you see in Texas and some of these areas. And, what Invitation Homes and American Homes for Rent, those large institutional SFR companies are doing built to rent communities and things like that. There's not a lot of opportunity for that in the markets that we're investing in. So that's where we can really strive with and thrive with scattered site, single family, redevelopment of individual properties and small portfolios, that kind of thing. So that's why I love what we're doing, because it's somewhat isolated too from like the interest rate market and stuff like that. How we're financing single families different than, we're not using commercial loans, like how you would to finance multifamily, that kind of thing. So yeah, we're still seeing, good rates on 30-year fixed, 30-year AM type product. And we have options for different things. So it's, and because of the markets we're in, and because of the supply and the demand, as interest rates have gone up over the last few years and all, we saw our pricing go up with it. You know what I mean? So rent prices absorbed it well, home prices absorbed it well, that kind of thing. And it's crazy. This, I see houses every day that I just think, that thing's going to sit, and it doesn't. It's like a freaking weekend goes by and they're getting above, price offer, listed price offer still, and people waiving inspections and things like that. And all. So it's still very hot in our markets. And I think it's going to be for some time. It's just, a lot of supply constraints.
Yeah, the way I look at things when you talk like about the market and supply constraints, and now I always joke, because take Washington D.C. for example, for I was complaining about the amount of affordable housing, and first thing people always knock the developers or whatnot, and I always joke, I'm like, they're their worst enemy, because they've got this stupid rule that you can't go above 7 stories or whatever the height is throughout the entire city. And if they would just take, okay, you got the Federal Triangle, which I can see there, but when you get to the outskirts of the city, when it's a diamond shape, where you get up to the top diamonds, or even some of the other locations, which allow high rises, allow somebody to go 20, 30 stories, and then in certain areas, and then it will spur some new development, or so forth, versus if you want to have it, because all it does now is there's limited supply, high demand, and just pushes the workforce housing further and further outside the city.
Exactly. Yeah.
But I look at your strategy more of what I'm more used to of a traditional real estate strategy of what I like to say, get rich slow. You're in an area that it appreciates over time. It's urban. It's not gonna explode like Boise, Idaho did, or Austin or some of the other places. But usually when those places do explode, they also pop. And Austin right now, I've seen people who have 1.5, $1.6 million homes, and now with the interest rates where they're at, if they can get $1 million for that home, they're lucky. Or trying to push that number, because the one thing that people need to still understand, whether it's workforce housing or any type of housing, is how much can somebody afford? That's what it boils down to. And companies do not pay somebody, oh, I'm going to pay you this much more because housing went up in this area this year. I wish it worked that way, but unfortunately it doesn't work that way.
Yeah, you're 100% right. And we do a lot, in networking and building relationships with city and municipalities, and go to a lot of those meetings and conferences and forums and things like that. And there's just massive disconnects, and a lot of people will look at developers as like, the evil developer or investor, and they're raising prices and things like that. And there's certainly some of that out there. But at the same time, I think people don't understand that pricing's up across the board. I mean? The land price is more, construction's more, management's more, all this stuff costs more than it did a few years ago. So deals need to pencil out at the end of the day. You know what I mean? And I think a lot of times people don't realize that. And affordable housing is a crisis. It's been a crisis. It's a crisis now. It's going to continue to be. And maybe the next generations, will be more in, willing to participate in local government and planning commissions and things like that, and allow for some looser zoning and stuff like that, because a lot of the supply constraints are created through zoning. I mean, it's just you can't build duplexes or triplexes and things like that. Like you said, you can't go up a certain amount and that kind of thing. So all of that, it creates an opportunity. You know what I mean? And from your side too, it's a get rich slow strategy, but you're going to cash flow along the way, which is really nice. And then you always have like the gentrification, which is a dirty word, and it's something that you could potentially benefit from as an investor in certain areas. And there's benefits to, in benefit, you're benefiting the community in a lot of ways, making positive impacts, but that needs to be slow and gradual over time as well. You know what I mean? You don't,
Yeah.
communities don't want to come in and displace anybody and stuff like that. And also, but there's a lot of opportunities if you know the right areas to be in. And one of the things we tend to do a lot of is invest around hospitals, and hospitals want to be in good areas, and they do
Yeah.
a lot of community investment and that kind of thing. So little things to look out for when you're in urban areas and stuff, to because people ask me all the time, it's like, are you investing in war zones? And it's no, we don't want to do that either. You know what I mean? Like, just because
Well,
it's affordable housing or attainable housing doesn't mean it has to be a war zone.
yeah, and that's, I think, the misrepresentation with like Baltimore and certain areas of
Sure.
Philadelphia is,
Oh yeah.
oh, it's affordable, so it must be heavy crime ridden,
Yeah.
bars on windows, doors,
Yeah.
and you're afraid, and especially, certain parts of Baltimore, which do get a very bad rap. I'm an hour from
Sure.
Baltimore, and, I've invested in Baltimore, and there's areas of Baltimore that are, really good, that still are affordable, and there's other areas that, you're right, you don't want to be near some of those areas. And really, it
Oh yeah.
still boils down to, there's still areas that are urban, that are affordable, like you said, that are workforce, where it's, a lot of people from the local community live and work there, and they take care of each other.
Yeah, definitely, 100%. And it creates opportunity. When I talk to investors and they poo poo, Baltimore, or liberal run cities and things like that and all, it's like I just see that as like that's an opportunity. When I'm hearing people say, well, like when you get on a plane and go to an event across the country, and your Uber driver's like, oh, I'm buying homes in Baltimore, that's when you should be worried. It's
Yeah.
just like that's when the pricing is going to be baked into the market. You're not going to be able to find as good of deals. So people ask me all the time, like, well, how come you don't go down south or something like that? And it's like, well, a lot of it has to do with you do what you know, you know what I mean, where and we're vertically integrated. So we want and we
Yeah.
want to be. And I think that's there's a time and a place to not be vertically integrated, and to leverage the expertise of a property management company and things like that. But I think to really be successful in affordable housing and to operate in those areas, you need to have control over the construction, because the GC cost, managing them, and the time frames, and the guy and the crews and all that kind of stuff can really make you or break it. And you hear
Oh,
horror
100%.
stories in that space, and a lot of times it's like, well, when you bought the property, you went on Craigslist to find a contractor that night or something. It's like, no, you didn't have a plan. You know what I mean? It's like, no
Yeah.
wonder. Like, I'm not surprised. You know what I mean? And same thing with like tenant screening and that kind of thing. It's like, well, how did you screen tenants and all? And it's like, well, I just kind of took the first person that came along. And it's like, well, no wonder you had a problem. It's like, so a lot of times when I have those conversations with people, it's just,
Mhm.
you have to look at it as a business and not just a portfolio. I think
Yep.
that's a really good way to not just look at this business, but real estate in general. If this is going to be your full-time gig, even if it is side hustle for you or something you do part-time, you probably want to look at it that way. But the way we look at the businesses is we look at it as a business and not just a portfolio. And that's where being able to scale comes into place as well, because there's a lot of benefits of that. And one of the reasons why people like multifamily so much, and that the economy of scale works the same way in single family too.
No, 100% agree. So as we, wrap up this episode, thanks for having you on. If there's, one piece of advice you could give to people out there who are looking to invest either actively, passively, what's, something that just pops in your head that you saw somebody do something, you're like, oh man, if they only knew this, and there's probably a million of them. So I only asked for one.
Bro, yeah, but when you said that, actually, it was like, yeah, the thinking of a million things were flowing into my mind and different ways, because there's so many different buckets in this space, and so I like to say flavors, of real
Yep.
estate, and then within it, there's the capital, the acquisitions, the execution, and all the
Yep.
tentacles that are involved there. But I would say probably, if you don't know this, if you haven't picked up on this by now, then let this be the maybe the last time you need to hear it. Is what's worked over the last couple of years isn't going to work over the next couple of years. You know what I mean? Like, you have to do
Yep.
things differently. Real estate is constantly evolving. There's a lot of different pieces of the puzzle that are making it evolve and change and things like that. You couldn't lose money in multifamily a few years ago. It's
Yeah.
like the tide helped everybody out, right? You
Yeah.
know what I mean? It's
Even if
just
you
like,
tried, I don't think you could. Literally,
literally,
like you could
if
try and like,
well, you hear those stories, where it's just
yeah,
like somebody went to a weekend seminar and they became a syndicator and they bought a building with like 97% vacancy and then
yep,
it somehow got down to 82 or something like that. It's like, what the hell did you do? But
yeah,
exactly, it's just like over the last couple of years, you really had to try to lose money in multifamily. That's not the case. It's not going to be the case. Projects are going to take longer. Underwriting has should have changed by now and is going to continue to evolve and that kind of thing. So I would just say what's worked over the last couple of years, you might need to reevaluate your strategy, and then don't overlook affordable housing. I have data that we use in our presentations and all, and it's easy. You can look this up. Affordable housing tends to outperform every other real estate asset class. So a lot of people kind of shoo it off, and because of the tenants or because of the areas or whatever it may be, the reputation of it. But if you're doing it right, it's probably going to beat out any other type of, asset class that you're investing in, because it has massive demand in any market. If we are heading towards recession or downturns and things like that and all, it tends to have even more demand. So I would say you got to just look at what you've done and then kind of plan for what you're going to do. And I always come back to supply and demand at the end of the day. I mean, is
yep,
looking at investing as a business. It's just, and to your point, just, I like to look at it from a micro perspective. It's like, where exactly am I investing? What is the supply constraints? Where's the demand? And then fill that need, and you should be able to find success doing it that way.
yeah. I'd also want to add to that, it's in every facet of your business too. Raising capital today is very different than it was several years ago.
Yeah. Oh my God.
Managing is very different. Everything is
Yeah.
very different. And, there was an article, and I can't find it anymore, but there's a great article about somebody in multifamily wrote that essentially, management from a few years ago, the way the markets were, allowed all your sins were forgiven, where today you really need
Mm-hmm.
to manage your asset.
Yeah.
And the analogy that pops in my head is, I'm a big football fan. When you have Tom Brady or Patrick Mahomes on your
Yeah.
roster, that
Yeah.
general manager can still have a lot of screw ups and those sins
Sure.
get forgiven. And I'll
Yeah.
use the Patriots as an example because
Yeah.
I'm from New England. The moment Tom left, now all of a sudden where they have to play an even playing field, and now all of a sudden it's, oh, now our management, because we got lucky, now we have to be execute on every front.
Oh yeah.
All of a sudden it's like, uh-oh, all of those, you know everything gets amplified because people, it's, oh, it was easy, now it isn't. And
Yeah.
now it's like, oh, I can't do what I've been doing all these years, I have to change
Yeah.
my strategy. And a lot of times that doesn't happen. And when it doesn't lead to success. So,
Yeah, you hit the nail on the head. Because you know what, I'm such a believer in that, and coming from a company that was around for a long time and it continues to be around for a long time, and then starting this firm, we've been in business for a little over 5 years. in raising capital and dealing with investors, you get that question all the time. Why should I invest with you guys versus somebody who's been around for 15, 20 years or something like that? And a lot of what I would say is like, my questions to those companies would be, how have they evolved to real estate? Because when they started, I'm sure the strategy they were deploying back in those days, and then the team that they've built around it, how has that evolved to fit the strategy that they're deploying today? And when the larger you are, the harder it becomes. You know what I mean? You can look at it as like a ship. If you got like a tiny little boat, it's easier to turn it, and move and ebb and flow. Whereas you're steering the Titanic, or a big cruise ship, it's harder to do that. You know what I mean? So when you have employees and you have all these people to do one strategy and the market changes and all, so sometimes I think that's good advice to an investor. When they're analyzing companies and partners to invest in, it's like, how have they evolved their strategy? Because you're 100% right. Especially I'm having on the fundraising side of the business. Things have changed so much over the last 10 years. It's insane. The social media, AI, it's just, back in those days, like finding an investment on Facebook was like, you'd be laughed off. You know what I mean? Like nobody talked about it. It was just like, it was unheard of. And I can still remember a meeting I had back in those days where it was like you were getting laughed out of the room. Nowadays, it's like, I don't know an investor that hasn't at least called, different, and had conversations. And a lot of them, and that's how they're finding deals and stuff like that. Through LinkedIn and also every part of the business has evolved, and that's great advice. I mean, to know if you're doing it yourself, how are you evolving? And if you're investing passively with others, that's a good question to ask them. How have they evolved over the last couple of years?
Great. Well, Peter, thanks for coming on today. If people wanted to reach out to you, what is the best way for people to connect with you?
Sure. GSPREI.com is definitely the best place to find me, to find out more about the funds and the company, our strategy, what we do. Plenty of articles, podcasts. Once this is available, I'll put it up on there.
Yep.
And, you can contact me through there. My email's there, call calendars there, all that kind of stuff.
Great. Well, Peter, thanks for joining us on this episode of Creating Wealth Simplified. As always, make sure to leave a review and like and share this with a friend on your favorite listening station. Thank you all. Take care, and we'll get you on the next one.
Thanks, Chris.
Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.